All right, so we had a little bit of a calm before the storm yesterday, and the storm started to show some signs today. So we had a little bit of a drop early this morning, and some people talking about how the CPI report got leaked, and then we had a big rally into the close. Again, big in context of today's range, not big in context of the range that we've been in for the last so many months. Very small move, but still big in the context of today's range, at least, to close the day. And again, as the CPI leaked, and I guess we'll find out tomorrow morning before the market opens. That's what appears to be the calm has been hanging on for, as the market's trying to digest and figure out whether we're going to get that June rate cut or not, and how that will impact what has been a historically strong risk appetite environment that we've seen, and as well as going into a really important earnings season, again, with one of the stronger 6-month moves that we've seen going into an earnings for the last so many years. So there's a lot of perfection priced in the market right now that we need to be able to keep feeding with just the right news. Again, whether it's macroeconomic news for the U.S. economy, whether it's earnings news on a micro level for individual companies, that it appears that we need to keep feeding the monster what it needs to be able to keep it up. Otherwise, that three-headed monster I've told you about before, commodities, the dollar, bond yields, can rear its ugly head and really tamp down that risk demand. And we're starting to see some signs of that, and I'll continue to show some of those signs that we've seen this first couple of days of the week so far this week, and then we'll talk about, of course, what our expectations are going into tomorrow morning and afterwards. With our, obviously, a discussion on sector rotation, very interesting sector rotation continuing in this past few days, and then of course our trade idea as a stock that's been on a trending move, but has kind of ended that trending move, similar to a lot of stocks. It's not the trending move you'd expect. So we'll talk about how to trade the end of that trending move into a non-trending move. So let's go ahead and get started. Today is Tuesday, April the 9th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where I take a look at all the trades we've done in prior videos, see whether we should stay in them, get out of them. We closed out a couple here in the past couple of days, so make sure you're watching that. We also put on the trade, today's trade before the market closed in that class. That live video there. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask. It's a big deal for us. So thank you to those who like this day in and day out. Our goal is to get to 100. So if you're liking these every day, keep it up. Thank you. If you don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's take a look at the S&P 500 here with the market forecast indicator as we head into tomorrow's CPI. You can see we continued this little rally off of Thursday's low, that quasi bull tag that we had, where we closed a smidgen there below the 30-day moving average. Again, it's not officially a bull tag because we didn't get the yellow line and the pink shading on the same day. But again, 1 day apart, you're pretty much the same thing. But remember, we don't clear it until we break above that high point, right? We have to close above the high point here of that day. We get that bull tag, and that's what really reverses this and basically sends us off again on a new run to the upside. Instead of a new intermediate decline, it'll just be a new leg higher. So again, considering how big the range was on Thursday, it's less likely that we will. But if we get a good market reaction to tomorrow's CPI report, then we can bust through the new highs and be fine. As of right now, we are still set up for a bearish expectation, right? Because we have the light pink shading. We did cross below market sentiment. The near-term line is below the near-term line while it's between the reversal zones. We're not very far up above the moving average. again, we are still below that high point. So, and if you look at other indexes, especially the Dow Jones Industrial Average, which has been the most bearish, it's got dark pink shading and a red line, still below the moving average. The near-term line, though, did get up above the intermediate line, so that's a positive sign, but not very far yet. So we'll see if we can, again, break up above that high point or not. And then, of course, looking at the Russell 2000, which is actually more bullish, has been more bullish today. It's still also below that day's high point. Its near-term line crossed up above the intermediate line. The intermediate line actually turned higher. That's why we're back to dark green shading and a green line. So the Russell and the Dow are diverging in completely opposite directions here. But again, we'll have to see if that near-term line stays above that. But as of right now, that's more positive than what we're seeing on the Dow Jones or any of the other large cap indexes for the market forecast line. If you look at the weekly chart, again, remember it's an extremely small range. But very small candle. It is negative. It's finally negative there, but it's barely negative. You can see we were also barely negative there at the beginning of that first week of the year, of the calendar year. So again, just being barely negative doesn't necessarily mean that we're now in bearish decline. Remember, the Dow Jones has formed a pretty decently strong bearish candle. So again, that's why the expectation is more likely that we will have a bearish response more so than a bullish response, because the market has already had a bullish response. It's priced in about as bullish of a response as you could possibly have to whether it's the CPI or earnings season or whatever, with the move it's had over the past 6 months. One of the strongest 6-month periods that we've seen ever, much less just being bullish at all. Looking at the 3 green arrow charts, again, we had 3 reds, for the S&P briefly. The Qs finally got a green arrow today, so it stopped. It's 3 reds. The Dow still has all 3 red arrows and the red line, so a little different than the other 2. And then the Russell, remember, yesterday was the day it lost its 3 reds and now it has a stochastic. Now it actually has 2 greens. In fact, it's the only index that has 2 green arrows down there. If you look at the 2-line version, we did jump back up. We did break below the 30-day moving average today at the lows of the day, but we ended up closing back up above the 8-day moving average. MACD is still below its moving average, so technically still convergence, still pointed higher, though not really moving much higher until that MACD can get going back up to the upside above its moving average as well. Again, you can see the negative momentum at least is improving. So it really wasn't that big of a decline compared to other legs that start intermediate declines. And then, of course, you can see the stochastics down there is out of bullish territory, but not in bearish territory. The Dow's different. The Dow does have more of a bearish stochastic indicator. In fact, even its moving average is almost in bearish territory. And we've been flirting with the 50-day moving average. That's a pretty sizable gap to fill in if we are going to fill it in. Down to the 200-day moving average, which is what you'd expect once you break these moving averages, if you don't just bounce immediately back up. We'll take a look at some of the other oscillators here. Let's see, we'll start with the DMI first. And you can see, again, bearish pattern. You're above 25 in the negative indicator. The positive indicator continues to decline despite today's rally. So it's still above 20, though, at 21. The Dow, though, it has crossed below 20, the negative. Again, it crossed below it here at the beginning of the year. Actually got right down to it briefly. But the negative indicator wasn't very high at that point. Negative indicator is about 30 now, so your ADX is actually starting to rise. So you can see how things are looking a little bit more dicey for the Dow Jones Industrial Average. Looking at the S&P, the RSI on the S&P, we are below 0, but not below 150. On the CCI, we are below 60. We're not in bullish territory, but we're not anywhere close to bearish territory yet. So you can see how the S&P is still kind of hanging in there. Whereas the Dow is the one that's has been more bearish than the other indexes. It's been in the lower half of the quartile. It actually has bearish momentum here with the red dots. See, when you look at the S&P 500, it also has red dots, but it hasn't had bearish momentum since November. That continues to be the case. Though we do have the weakest bullish momentum that we've had, and you can see the bandwidth is getting really, really tight. So we are setting ourselves up for a squeeze play, a breakout move, one way or the other. It could still be a breakout move to the upside. We've seen bullish moves lead to convergence and then to another bullish move. In fact, on the current intermediate run, we've seen that. So it's possible that we could get that pattern again. Though more likely that, again, whether it's the CPI or whatever a catalyst may be, it's more likely that we wouldn't do that this go around. You can see we haven't had a high for a while, so we have dropped below 70. The low point's still here and will be here until for about another week until we clear this low point, and then it will be last week's low point will be the low of the 4 weeks, which means that we have a really tight range. The diamonds, the low, remember we talked about this before, the low has jumped up pretty significantly there. You can see this low point, the low has moved all the way over here, and we came really close to getting a new 4-week low today. So the Dow really has, and you can see too, the Dow is trading in, the S&P is still in bullish territory of the stochastics of its 4-week range, but the Dow is not, clearly in bearish territory, and your moving average now is almost out of bullish territory. So we've clearly turned lower. In fact, when you look at the hull, we didn't look at this on the weekly chart, but you can see how we're still kind of grinding away there. That's not the case for the diamonds. The diamonds, the 20-week hull has turned red. The parabolic SARs have flipped up to the upside. And as I mentioned, you're getting more of a bearish candle than what we've seen. And your MACD is below its moving average, which is now falling. So, things have clearly turned on the Dow, even if they haven't necessarily turned anywhere else yet. If we take a look at today's volume and trading range, kind of similar to yesterday, a little bit above, below average this time, and the range ended up being above the average. Remember, the averages tend to rise when you start to have more volatility and more of a decline. You can see we've been rising on volume. We've had a little bit of a rise the past few days, and there it's not till you break that 1% mark though that things really start to move. So that means we need to start getting more 5, 6, 7 point day ranges or more to get the average up above the 1% level. And clearly we're not there yet. And if you look at the volatility here, as I mentioned before, we're kind of coiling right now, setting up a squeeze play. We did break above 15. We pulled back down to 15. We're still in between the 95, so we haven't really broken above that 90% mark, much less the 100% mark relative to VXV. That really signifies that we are in intermediate decline here. The correlation of the VIX with the VVIX, the volatility of the VIX is pretty strong, even if the VVIX itself has pulled back down here to 84. So after being so extreme going into what was, for me, my spring break, coming out last week, while I was going with a big jump up into towards 90, we've now got a little bit of a breather here back, but still at 84, not necessarily extremely low yet, but also not like breaking down yet either. So you can see the VIX is still clearly above the 200 days. The other attempts above the 200 day, we get immediately back below it. We've gotten above the 200 day, and we haven't. In fact, we're still above the 8-day average of the VIX. So we're still at a high level, despite the 3-day decline. We're still at a high level for the VIX. It's just a little bit of a pullback, and we'll see if we were to break down back below the 200. Now would feel better, like these other scenarios where we can get back to a new low below potentially that 50-day like it did the last time. All right, now let's take a look at what's driving this price action. You can see over the past 3 months, gold has just continues to rocket up to the upside. The past week or so has been a big time move. In fact, if we take a look at the past 5 trading sessions, before we take a look at today's, you can see gold continues to be just a big mover, up 3% over the last 5 trading sessions. Commodities doing pretty well. A lot of it's due to weakness in the dollar. Yields were down, which means bonds were down, which means yields were up. But bonds have since rallied late yesterday and including today. So if I just look at today alone, here you can see gold still was relatively strong, not the strongest. Bonds ended up being the strongest along with real estate. emerging markets benefiting from the dollar not going up, I guess. But commodities did not benefit from the dollar not going up, as commodities gave back some of their recent gains. They had been so bullish. When you look at how they've been performing, commodities, I mean, that's a big time move. They've kind of gone a little parabolic here, and we'll see if it ends up holding this breakout above the 200-day average or not, specifically crude oil, which is easily above its moving average and now has a golden cross scenario here. But you can see when you get these golden crosses, a little bit before, a little bit after, you get these little pullbacks. So we'll see if that ends up being the case here. But you are above the value area of the 1-year chart. So there's obviously a lot more support than there is resistance, is what that basically means, despite the fact that your MACD is relatively strong and pulling back here in your stochastics as well. Of course, the main topic discussion, which especially will be tomorrow, is what's going on with yields. And you can see the 10-year yield is still moving up higher here. In fact, if I were to take a look at it here, let's go over to the 10-year yield. You can see we're still right around at 4.35% mark. 4.4, 4.5 is really kind of an important level for this, and it's still kind of working in that direction. The odds of a rate cut today drop back down a little bit. Jump back up a little bit. The odds of no rate cut dropped down today, as we were at one point down around 40, low 40s, jumping back up to 46. But you can see there's still about a 50-50 shot going into an important data release tomorrow. And if you were to take a look at the nowcast for inflation is expected to be right around 0.3%. And we're expected to duplicate that the month afterwards. So keeping the year-over-year levels at pretty strong levels here. The core is still higher than the headline, and they are projected to go down only because the April number was so high. But once we get past that April, the May number is actually pretty low, so it's actually going to give us a basis to jump up, unless we get a May figure that's like 0.1% or lower. So despite the strong numbers on a month-over-month basis, we're still, but again, remember these numbers here, whether it's 3.41, 3.36%, if you look at that number historically, and I'll show that to you right here. So if I were to go percent change from a year ago, and then we'll add on a line for, let's say, 3.35%, so somewhere in the middle there. So if that's where our year-over-year figure is, you can see that's still a high number. If you look at, yes, it's lower than where we've been, but before that, it's higher than anything that we had seen since 2011, when we were having the credit crisis, right? And we were up at these levels, or prior to that, going into our recession, the Great Recession that we had, and then the housing bubble bursting there, and then the tech bubble bursting. So, this is a high level for yields, for the CPI, a high level for CPI. And so, the fact that we're not falling back down to 2% is what's giving some people a little bit of pause or concern about how things may perform here. One of the other elements of strength or weakness in the equity markets has been what the dollar's doing. And so at least the dollar's been pulling back. I think that's been helping stave off any more considerable weakness in equities there. But again, the pullback hasn't been trend changing. It's still on a bullish move. The MACD is still positive. You're still in the upper half of the stochastics range there. So it's just a matter of whether we'll bounce off this low or break. Of course, until we break, you expect that you bounce off support levels and move up off of higher lows towards higher highs would be the expectation. Looking at the comparison chart, you can see again energy has been the big winner. So gold on the asset class perspective, but energy on when you look at the sector, the U.S. large cap sectors continues to be the big performer. It's doing well over the past week. Real estate doing the best, right? Continuing to move up there. Staples, healthcare, financials, three things that don't typically go together, but they've been your weaker performers. If I just take a look at today alone, Oops. Try that again. There we go. Real estate was your big winner today. Everything else kind of matching. So utilities, staples, healthcare, or technology, communication services, or consumer discretionary, all kind of matching there. Again, four areas in the market that typically don't go hand in hand. Your industrials, energy, financials have been cyclical areas of markets that had been strong. In fact, if you look at the relative rotation, I believe that they're all still in the leading quadrant. There's energy, industrials, and financials are down here at the bottom end of it, though they're not really gaining a whole lot of momentum. In fact, they're not getting any momentum at all. And industrials, you could say, is losing momentum. Communication services also kind of losing that momentum too. Really, the only things that have been picking up were these dollar-sensitive areas. And that's, again, we've seen that weakness in the dollar and the benefit that is given to these sectors. How likely is that going to be? Healthcare, real estate are safe haven areas. Staples is another safe haven areas. They're in the lagging, improving areas. But they would be areas that would outperform in the markets if we're actually going to be in a bearish run. And that's, again, technology has been underperforming for quite a while. If you take a look at utilities, typically utilities outperforms in a bearish move, and you can see utilities has been outperforming. It hasn't outperformed really for a good chunk, just briefly during some periods here. Obviously, if I were to go back to 2022 during our correction, you can see it outperformed for quite a while, all the way up to that October low point that the markets had. But here we are again now, outperforming the markets, and you think, okay, that's typically something that occurs during when the markets are weak. You can see the relative strength here starting to, at the end of 2021, it started to pick up towards its moving average on a weekly basis before breaking above in 2022, and the markets really went south again, all the way to those October lows right there, and then eventually at the end of the year, those December peak in relative strength, and then obviously underperforming the years that the market was bullish in 2023. Well, you now have positive momentum. You're coming off a very low relative strength. So we're setting ourselves up for outperformance in utilities that would coincide with an increase in risk aversion. That's not something that does well in a risk appetite environment. All right, that brings us to our trade idea of the day. And let's take a look at a match here. Whoops. I'll just do the symbol match group. You can see it's stock has been pretty much going sideways for the past so many months on a little bit of a bearish tilt, but the intermediate line is above its market sentiment. The near-term line is crossing above the intermediate line. So while it's on a bearish tilt, there is some positive developments there. If you look at the weekly chart, try that again. You can see the candles have been getting really small. We've been converging for quite a while as the MACD has been rising up here, getting closer and closer to zero on this long-term basis. Looking at the 3 green arrow chart, you can see that we are pretty much converging right along this point of control. Big volume node, one big volume node. We're below the 200-day moving average. We're below the 50-day moving average, but we're above these short-term averages. So things starting to look a little up, looking a little bit better there for the stock. As you can see, the DMI is, both lines below 25, so neither one of them are really breaking out or trending in either direction. Looking at the RSI and the CCI, you can see the RSI is sitting right at the chart's midpoint. The CCI is also closer to zero than it is anywhere else. Looking at the Ichimoku cloud, there is no trend going on right now. It's a very weak trend. If anything, we are below the cloud, but we're not trending lower anymore. The Bollinger Bands and the stock itself is in the middle of the bandwidth. The bandwidth itself is relatively low compared to the 150-day highs and lows. The bands themselves are slightly inside the Keltner channels. So you can see there's not a whole lot of movement here. So what I decided to do was to do a condor trade going into, even with the earnings announcement coming up here, doing a condor trade going into May expiration. You can see selling the low 20s deltas, buying one strike away. For the long side, you can see the trade set up with those break evens right there. So those two lines in the break evens are here on the chart. So again, as long as we stay centered around that point of control, which we have for multiple months now, even with the earnings announcement coming up, the nice thing about the earnings announcement is we can get a pretty decent return here. Get rid of the, there we go. We can get a pretty decent return for 2/3 of what I normally put at risk. So this is our normal return, but it's not our normal risk. It's about 2/3 of our normal risk because of the earnings announcement that makes it so I can get more premium for less risk on the trade. Also makes it less likely, so we'll see how that plays out. But once that earnings plays out and the volatility comes out of it, then that will be a benefit to us, since iron condors are a negative vega trade. So they'll take advantage. You can see the negative vega there. That will take advantage of volatility coming out of the markets. All right, and that's our trade for today. All right, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com. Follow me and like me on Twitter and Facebook as well. Have a great rest of your evening, everybody, and we'll see you all next time.